Hello, this is Brian Resney, President of Resney Wealth Management. I'm bringing an update about the market and the economy so you can better understand not only what we see in the global landscape, but also how we're positioned and any important changes we may be considering in the near future. You know, the economy, generally speaking, in the U.S. continues to be on a stronger and stronger footing. Now again, not as strong as people would like, and that never is the case. We're not seeing any euphoria like we saw back in 2006 and 2007 with the housing market, but generally speaking, the housing market's getting stronger. Now you have to remember, back in the mid-2000s, you know, we had housing starts of 2.5 million a year. Right now we're somewhere around 1 million a year, which is kind of a normal average. So what I would tell you is we're back to the old normal, which is actually a healthy normal. We continue to grow the economy. Housing obviously is an important part of that, but don't expect your housing values to jump 20 or 30% in the next 5 years. In fact, I would say going forward, if you see a 1% increase in the value of your house, you'll be extremely lucky. Housing typically is tied to income, and as income slowly rises, typically home values slowly rise along with it. The euphoric numbers that people saw in 2005, 6 will probably never be seen again, at least in the next 25 or 40 years or so. But at the end of the day, housing is only one part of the economy. As we continue to see government spending being curtailed, which is a healthy thing, we're seeing the private sector actually starting to pick up just a little bit. At the end of the day, as long as the housing economy is growing, as long as corporate earnings continue to grow, I believe we could see substantially higher prices in various equity markets over the next 3 to 5 years. Now, I'm not predicting we're going to see 20 or 40% returns anytime soon, but what I'm trying to tell you is this: relatively stronger investment sectors outperform, relatively weaker investment sectors underperform. What we've seen in the last week or so is about a 2 to 4% sell-off in a lot of the equity-based markets and in some of the bond markets. This is that healthy correction I've been talking about probably for over 2 months now, and this is healthy. What it's going to do, it's going to help people reposition or reallocate some money to those stronger sectors, which I firmly believe will happen. What we're seeing, though, is we're seeing Japan drop quite a bit. In fact, Japan's market's off about 12 to 15% just in the last couple weeks alone. At the end of the day, something that goes up too fast often comes back down to earth. And we're seeing that with Japan. Ultimately, what we're seeing in some of the emerging market economies is growth, but their stock markets are basically weak. So what we want to do is we want to continue to be in those stronger areas that we have been in throughout 2013, which continue to be small and mid cap and large cap generally in the US, and small cap in the emerging markets. Now we're going to be re-ranking our global tactical portfolio as we get into the end of the month, and we will be making a couple changes to our fixed income areas, so make sure you watch your accounts for that. I think one of the areas that's going to really blindside retirees, again, not our clients because we're actively managing their money, but I think non-clients. In fact, I continue to get so many phone calls about bond investments, whether it's individual bonds or bond mutual funds. I think too many investors overloaded the boat on bonds and bond mutual funds and continue to own these. I think this is going to be a real problem spot for the next 3 to 5 years plus for a lot of retirees. Too many bonds, too many traditional bond mutual funds, in my personal opinion, is going to spell mediocre returns and probably substantial risk. What so many investors fail to understand is bonds and bond funds can go up and down, just like any investment market can go up and down. Unfortunately, with interest rates being at all-time lows, I think the risk and the return of traditional bond and bond funds, the return is going to be limited at best, and I think the risk is very heightened at this stage of the game. So if you are not a client, I would urge you to review that bond portfolio or those bond investments you own, and you may want to be making some important changes. Of course, if you're a client and you have a question about your portfolio, please call the office. If you're not a client and want to become a client, please call our office for a consultation. We always like taking on new clients who are nice people to do business with. Make sure you have yourself a safe and profitable week.